I'm Emily Uwemedimo, Managing Editor of Automotive Logistics, and welcome to our ASEAN-focused live stream. The theme of today's program is about unlocking potential and driving supply chain performance and operational excellence. Over the past 12 months, we've been building a picture of what that actually requires across the ASEAN region through our editorial coverage, our market intelligence, and our conversations with executives on the ground. So to open today's discussion, I want to start with where we were last October when we held our first ASEAN conference in Singapore and launched our ASEAN Automotive Logistics Market Report. The headline across the two was certainly growth. We predicted the region's logistics market was worth just over $10 billion in 2025. Our forecast projected it reaching $11.6 billion this year, rising to nearly $25 billion by 2036 at an 8% compound rate. And production was expected to grow from roughly 4.5 million vehicles to more than 7 million across the same period. And these figures, which you'll see displayed on your screens just now, are based on data from 2024 and 2025, with 2026 estimates, so they do capture the market, slightly before several of the developments we'll be discussing today. But it's worth highlighting, though, that even then, the growth captured here was always uneven. Light vehicle sales across the ASEAN 6 fell over 5% in 2024 to 3.28 million units, and you'll be able to see some of those figures. They are a bit small, but if you zoom in, you'll be able to see some of those figures on the table on the slide just there. Thailand and Indonesia bore the worst of it, with volumes down 25% and 13% retrospectively. Malaysia, Vietnam, and the Philippines were heading the other way, with sales rising on stronger consumer sentiment and new model launches. With that mixed picture, a structural shift was already visible. By mid-2025, EV penetration across the ASEAN 6 had reached 13% of passenger vehicle sales, up from 9% the year before. We saw Chinese brands were localizing manufacturing in Thailand, Indonesia, and Vietnam, and Japanese OEMs were consolidating operations in what they saw as more resilient markets, particularly Malaysia and the Philippines. Then in September last year, we sat down with Susanne Lehmann, Managing Director of Volkswagen Group Malaysia. She explained how these pressures were translating into operational challenges. She described Volkswagen as operating under highly localized restrictions with very low volume, which is challenging. She also said the only sustainable solution was to increase volume, and this created what she described as a self-fortifying effect. Higher volumes reduce per unit costs, which improve pricing, which support further demand. And without that scale, real localization was hard to reach. She also made a comparison on logistics costs. Singapore, she said, was 3 to 4 times more expensive than Malaysia for comparable operations. Volkswagen had already moved its Asia Pacific after-sales parts distribution from Singapore to Malaysia for that very reason. So I'd really encourage you to read more from our sit down with Susanne after this live stream. She definitely goes into much more detail than what I've just depicted here. The link has just been shared with you in the chat. So I do encourage you to bookmark that for later. Then I want to pivot now slightly back to our conference in October. A month later, there was a stance that defined the day. It came from Stellantis that the supply chain within the region should be treated as a growth driver and not a cost center. And here's our Chief Content Officer, Christopher Ludwig, sharing some of the conference insights from the floor of that event.
Welcome to Singapore, the logistics heart of Asia Pacific in so many ways, and here where we're so happy to host the first Automotive Logistics and Supply Chain ASEAN conference, focused on automotive supply chains here in Southeast Asia, looking at challenges across the region, optimization opportunities, integration, digitalization, and much more in this important region, which is growing. We see a strong growth forecast, but full of challenges, the volatility, whether it's the weather, whether it's different regulations across the region, whether it's fragmentation. But nonetheless, huge opportunities for logistics and supply chain to add value, and we talked about that across the day. We started with a keynote presentation from Ashwani Mupasani, Sunny, who is the Chief Operating Officer for Stellantis across India and Asia Pacific, and he talked about how supply chain is at the heart of increasing speed for Stellantis, shortening order to delivery times, getting vehicles to customers faster so that it reduces inventory and capital costs and helps the company earn money. He talked about how supply chain needed to be seen as a growth area, not just a cost center. And that means investing in the right solutions and partners to increase that speed, to have alternatives. He shared great examples, for example, of hub and spoke models where vehicles could be centralized and distributed to different countries in this region, or circular supply chains for packaging and much more.
So as you just heard there, that phrase from Stellantis' Ashwani Mupasani really became the through line of the event. We only heard a snippet from Chris there, but he does go on to share how other speakers really built on that same idea. BMW's Dr. Michael Nicolaides described ASEAN as the company's emerging fourth pillar globally and called for greater harmonization of regulations across the region. Susanne from VW was also with us as a speaker. On stage, she updated the positions she set out in September and offered a specific example of how customs fragmentation works in practice. And we had VinFast Global Component and Supplier Quality Director speaking about the difficulty of building a supplier base in a market where the local capabilities haven't yet caught up with the ambition. But since the conference, I would say, a number of developments have really tested the assumptions in our forecast. Whatever the broad pressures on the market seem to be, investment in electrified manufacturing has continued at scale in Thailand under its EV 3.0 and EV 3.5 incentive schemes. Thailand allowed car makers to really, import EVs at preferential rates and offered government purchase subsidiaries on the condition that they establish local production and compensate for imported vehicles through domestic manufacturing. Thailand's Board of Investment reported this week that 198 EV-related projects have now been approved, worth more than 137 billion baht. That's approximately $4 billion, if I'm working my maths correctly there. And what's notable is that the investment spans across the full EV ecosystem, not just electric vehicles. It includes batteries, vehicles, components, software, and charging infrastructure. So electrified vehicles of all types, including hybrids and plug-in hybrids, as well as battery EVs, accounted for more than 44% of new vehicle registrations in Thailand last year. So as someone outside looking in on the market, it really seems that the strategy within Thailand has moved beyond, battery EV alone towards building a more connected supply chain spanning production, R&D, and testing. But I wouldn't say the investment there has been frictionless. Earlier this year, 10 Thai automotive associations submitted a joint proposal to the government calling for fairer conditions between domestic manufacturers and importers. They argued that incentives should, target activities bringing genuinely new capabilities rather than competing with existing firms. And they flagged the cost disadvantage Thai producers face on strategic inputs where Chinese manufacturers benefit from lower raw material costs. And with the current incentive scheme ending in 2027 next year, the question of what replaces it is becoming even more pressing for the industry. And then I want to pivot a little bit because another major development that we have seen this year has been the crisis in the Middle East. On the 28th of February, coordinated US and Israeli strikes on Iran triggered a crisis in the Strait of Hormuz. And we're really starting to see the cost impact of that following now. Brent crude rose from about $70 a barrel before the conflict to around $107 by early April, feeding directly into higher freight freight and distribution costs across the region. The upstream impacts were, particularly prominent here, with tightening feedstock availability causing plastic prices to jump by about 37%, driving up the cost of composites and rubber used in vehicle components. And the impact of that is, likely most felt by the tier 2 and tier 3 suppliers operating in tighter margins. And our reporting identified that Thailand, Vietnam, and Malaysia are the markets with the greatest exposure. There was also a downside effect. Rising fuel prices appeared to accelerate interest in electric vehicles across the region. A VinFast spokesperson, as reported in our coverage, indicated that the conflict-driven fuel price rise could support the company's profitability targets in 2026. And then the US-Iran deal was announced in mid-June. That included reopening the strait, but the situation has deteriorated again this week. Iran has been accused of targeting commercial vessels transitioning in the strait. The US has responded with fresh strikes on Iran military targets, and President Trump said yesterday that he considers the interim agreement to be over, but talks can continue. So for shipping companies, certainty definitely remains elusive here, as Salim Lyon's chief operating officer put in our European conference earlier this year. Even if the war ends tomorrow, there's already so much cargo piling up that this will have an impact on the market. And I can say that assessment probably looks more relevant than when it did when he said it back in March. So, if we really layer those kind of stories together, you have a kind of a view of what the current operating environment is. Thailand is investing billions into electrified manufacturing, as we heard, and the wider EV ecosystems. Vietnam's demand is surging, but we're still looking at, how that is affecting kind of localization within the region, and if this is going to keep up with the pace of growth. The structural challenges that our report really initially identified in October around that cross-border complexity, infrastructure gaps, and regulatory fragmentation, I would say have only been amplified by the events of the past 8 months. So this picture is kind of still emerging. It's still giving way to very much lots of opportunities within the market, but the conditions for capturing that opportunity have tightened. Growth hasn't gone away for the region, but what has changed is who gets to participate and what it takes to compete. So as I said, that's a very, very brief kind of overview of the market right now. And our discussion with our panelists will get deeper into those aspects, I have no doubt. So let me briefly walk you through the rest of today's show. We'll be diving straight into a panel discussion with our speakers, exploring 3 key themes that you see here on your screens. We'll start with localization, what happens to the inbound logistics side of things when tariff policies force car makers to build locally rather than import. We'll also look at fragmentation, how to operate across different regulatory environments, and whether AI and digital visibility are making that any easier. And then we'll wrap up with looking at resilience and looking at what it actually costs to build a shock-proof supply chain in a region where input prices, shipping routes, and the competitive landscape are all moving at scale. And then just a few housekeeping notes is this is very much an interactive session. One of our speakers will be sharing a short demo with you, so do stay tuned for that. And your questions are very much welcome at any point during the session, so I do encourage you to start sending them in, and we'll get through as many as possible during the time we have with our speakers. But I'd like to welcome them to the stage. Joining me are two people who very much run the supply chains across this region day to day. We have Eric Van Steen, Vice President of Supply Chain at Bridgestone Asia Pacific. He's responsible for planning, procurement, and logistics across Asia Pacific, India, and China, overseeing 11 factories and more than 100 warehouses and a procurement spend above $2.2 billion. Eric, thank you so much for being here with us. And then we have Tuan Vai, Vice President of Supply Chain Management and Logistics for Asia Pacific at Schaeffler. Tuan is based in Vietnam and has played a pivotal role in the logistics, factory setups, lean manufacturing, and supply chain management for the company. Tuan, welcome, and good to have you in the discussion as well. So I want to get straight into the discussion. You were both with us in our conference last year in Singapore. So I want to just get a sense. I just gave a kind of a timeline there of kind of what the market was looking like and kind of progressed over in the last 8 months since we spoke. But looking back over that same period, I want to get a view of how far your supply chains have evolved in practice, and where have you made progress, and kind of what challenges you're still facing. Eric, let me come to you first.
Thank you. Thanks for the opportunity. Anything happened since we last met? Oh yes, something in the Middle East. It's quite typical indeed for the supply chain and, well, life in general over the last few years, where these sort of big disruption events would come every, 2-3 years, and now you have 2 or 3 per year, right? It makes it a little bit harder, frankly speaking, to make progress on some of the more fundamental aspects. Having said that, in some ways also drives you to accelerate some of the initiatives. So, we're progressing on a number of things. We are still in the process of right-sizing our manufacturing footprint. So we've made some progress in that regard. The tariff impact, which seems like a long time ago, but is obviously still there as a carryover from last year as well, and we'll likely get a new impetus in the next few months now with the Mexico, Canada, and US trade agreement being under review again, which matters to us because we are running a global supply chain in many ways as well, with the Asia part doing a lot of supply to the western part of our business. We're obviously continuing on the digitalization roadmap, so investing in advanced planning solutions. Of course, AI is coming on top of that now, not just this year, right? But it's starting to accelerate. We're taking a much more strategic and I would say profound approach to that, and I'm sure we'll get to talk about that a bit later. But so it's dealing with the sort of disruptions that in whatever shape or form keep coming, and whilst at the same time managing our day-to-day performance levels in terms of filling our factories, getting the goods to the customer through the retail or the OE channels, continue to invest in, I would say, mainly in digitalization, and of course in our people as well, adopting the digitalization and the new technologies that have come to the fore and that we can now start using.
Thanks, Eric. A great comprehensive answer there, and definitely lots to unpack, which we will further into the panel, especially around that kind of digitalization aspect and AI and visibility. Tuan, the same kind of question to you. Kind of how has your supply chain evolved in the last 8 months since we last met?
Yeah, first of all, thank you for having me, and thank you, Emily, for a nice introduction. There was one technical problem that I couldn't hear what Eric was saying, but it seems like you hear me clearly. I will try to keep it short. I'm pretty sure Eric covered a lot of topics for Schaeffler, being here in the region, in Asia Pacific, of course. from external, you mentioned that the Middle East crisis, of course, has also an impact on us and put quite some tension on our transportation cost, but also then lead time, which then is for us important with 12 manufacturing plants in Asia Pacific. And of course, what did it mean then for us internally? We had to focus then more on transport efficiency, mainly working more where we can further improve on the pre and on carriage. So we took quite some initiatives in this regards to further reduce the lead time and cost, as we could not basically influence further the main carriage, right? And as mentioned, overall transport efficiency, I think that's what we have been working strongly about. Apart from that, last eight months have been really busy at Schaeffler, also Southeast Asia. We had an transfer of our regional distribution hub from Singapore to Thailand, started somewhere end of last year, still keeping us busy. As of course, it's a major change in our network. And apart from that, as with the merger of Schaeffler and former Vitesco back then, October 2024, we handled a lot of integration topics and mean also that we had to look at our overall warehouses, processes in terms of transportation, all those kind of things to further work on those synergies. I mean, and also consolidation of further locations, warehouses, organizational setup. So yes, externally and internally, it has been quite a busy 8 months.
Thanks, Tuan. Well, we could hear you clearly there on our end, and you kind of echoed kind of what Eric just said there. So all good on our side. Thank you, Tuan. Eric, I'm going to come back to you because your remit, as I kind of said in your introduction, spans both China and ASEAN, but also your supply chains are very much seen as global, as you said. We're hearing more discussion around Chinese manufacturers kind of diversifying their production across Southeast Asia, including countries such as Thailand and Indonesia. So from your perspective, how is that changing the competitive landscape for the industry?
Yeah, this is the big one, I would say. Broader than tariffs, broader than the Middle East crisis and whatever else has come our way, because this is obviously a long-term structural, challenge, but obviously clearly an opportunity as well. The good thing is that we are reasonably well established in the China operations. We have manufacturing there for a number of decades already, which allowed us to build up some good relationship with some of the key players in the industry, which obviously in the last 3-4 years have been really taking off domestically as well as globally. What we try to do is to change our own operating model because, as I said, these EV car manufacturers are domestic, but a lot of their product is for export as well. So we take a more global approach in the way we engage with these customers to match their ambition on one level, but also their global operation model. Right, a company like BYD is manufacturing in Thailand, in Brazil, in Europe. So we're trying to match that by having a local presence, but also a global presence, both from a relationship, from a tire development point of view, R&D, but also from an obviously manufacturing footprint point of view. So concretely also in regards to that manufacturing footprint, we are changing the capabilities that we have in our plants across the region. For example, for EV tires, noise is very important, right? Because you don't really hear the sound that comes of a tire when there's already an engine running, but when there's no sound of an engine, the tire sound becomes quite important. So sponge material is embedded in most of the EV tires. So you need to have the right technical capability to put that into a tire in a safe, high quality and an efficient way. So The development of the tire itself is also a little bit different. So yeah, all of those capabilities we are trying to keep pace with and in advance of what the market is doing to make sure that we can cover these customers in the most efficient and effective way.